Hello, everyone. Thank you for joining Professor Siegel live on Trump's tariffs impact. Today, you will hear from Jeremy Siegel, Wisdom Tree Senior Economist, Jeremy Schwartz, Global Chief Investment Officer, Kevin Flanagan, Head of Fixed Income Strategy, and Sam Rines, Macro Strategist Model Portfolios.
Well, team, thank you all for joining us. We're continuing this series with all the action, the markets professor. There's headlines up and down, and it'd be great to just get your latest take. Then we'll go to Sam and Kevin for some of their views on the headlines in the deal making for Sam, and Kevin on the Fed and Powell. Professor, I'm sure you might be reacting to these headlines from Trump about Powell also. So we'll kick it over to you to kick us off here.
Let me mention a couple of things. Let me talk about Powell for a second here. There's very few things about that I agree with Trump, certainly about all this tariff thing. But believe it or not, I agree with him, actually, that Powell should seriously consider lowering rates. I was actually rather surprised by his testimony for two reasons. One, he did not acknowledge how good both the PPI and the CPI were last month. And secondly, he started talking about inflationary expectations, which we certainly see in the survey data, but not that much in the other data. And he emphasized an awful lot about the tariff inflation destabilizing or potentially destabilizing inflationary expectation. Now, that was something that in his March FOMC meeting he played down. He said that, sort of that's a one-time increase. Most economists think that's a supply shock, a negative one to be sure, but one that you not necessarily should think about raising rates. Moreover, as you know, I pay attention to the money supply a lot, given all my studies, and the money supply growth has been pretty weak over the last 12 months. I mean, we've been averaging 4.5%. We should be going at least 5.5%. So we're not, this is not an inflationary liquidity environment. And he should think about being preemptive. Now, it certainly doesn't look like that's going to happen on the May meeting, although June meeting it might. But listen, I think these, that everyone who's listened to me know I'm very negative on the economic impact of these tariffs. Nonetheless, that's one reason I think he should think about lowering rates going forward, even if we get an inflation bump. That supply side bumps. Now, let me just reemphasize the inflation we had during the pandemic started out for a few months as a supply side bump and then went into a huge demand bump with $5 trillion worth of budget deficits and money that was just thrown at everybody. And I mean, that was the sustained inflation. And we're not seeing that at all this time. So that's something that I think is important. Let me also mention that the real data, again, we got claims, as you know, Thursday it showed a slight decrease. It's going to be clouded by the fact that, listen, there's a little bit of a rush of buying, maybe more than a little, ahead of tariffs. So, people will say, well, do we see spending go down? No, you might see spending go up, but it's all borrowed against the future. But it's going to be hard to interpret that because, that spending will go up. By the way, the first quarter, the current, Wall Street is between 0 and 1% GDP for the first quarter. The Atlanta Fed is still slightly negative, even with their upgraded with gold imports. If you take those out, they're -2. I think, Wall Street's right between 0 and 0.5, but I'll tell you the margin of error is we could see a negative print on this first quarter. And, rule of thumb, 2 negative prints on 2 quarters is considered a recession. So, we could be very, very close, even though we're going to see some Russia buying that we see right now. An interesting statistic, for those of you who follow Polymarket, the markets that, like Kalshi and Polymarket, predicted, and others that put in contracts where people put real money on what it is. There's one contract on Polymarket is how much will President Trump collect in tariffs in 2025? And they give you various dollar ranges. The one where the biggest money is placed is the $100 to $200 billion range. By the way, which is only 2% of 1 year's government spending. So it's not, it's or 2% of government taxes, maybe 2.5%, because we don't quite collect as much taxes. That's why we have a deficit. But it's a trivial amount. Trump himself claims $300 to $600 billion, but when you put 145% tariffs on, you basically have an embargo against China, which could really make that go down to zero. So you're not collecting any revenue unless they squeeze it out some other way. All these things, of course, are costly going forward. But I thought that's an interesting statistic. By the way, there's also a contract of percent that think there will be a recession in 2025. It is over 50, between 50 and 60. I would say Wall Street's between 40 and 50. So, I actually think if I had to, I think it's over 50. Now, I don't think it's 75 or 80, not yet. And of course, it all depends on what Trump does. What one should also remember, we're going to get deals. He's very close to a deal, close to a deal with Japan and all that. And that will temporarily excite the market, but there's going to be much less there than meets the eye. Let's face it. They're going to promise to do some things. They're going to open up some markets. I have said repeatedly that even if they took off all tariff and non-tariff barriers, the U.S. would run a rather sizable trade deficit. The trade deficit is because of the dollars flowing abroad that they want to invest in the U.S., and it is necessary to have if you want to be the reserve currency, you got to have a trade deficit. The trade deficit is not an emergency. It was not an emergency, and it has never been an emergency. The trade deficit. I remember people telling me 30 years ago it was an emergency and it would cause a crash of the dollar, and I laughed at that. 30 years later, we had 30 consecutive years of trade deficit since then. The dollar is stronger than it was when people were telling me how terrible the trade deficit was. But that's another issue. Let's talk a little bit about earnings. So I don't know. You have several types of CEOs. You have one, on the earnings. So what does the earnings tell us from the first quarter? Almost nothing about what's going to happen over the rest of this year. Now, let me qualify that. I mean, what happened to UNH today clearly tells you something about UNH and what's going to happen this year. Then that's nothing to do with tariffs, what happened to UNH, right? So clearly there is firm, specific information in there. But certainly don't think that there's any information in there that has anything to do with, what the demand is going to be later on. Now you say, well, then isn't the CEO responsible for giving a forecast? Well, some CEOs do their homework and some CEOs don't do their homework. Kirby of United Airlines said, all right, we don't have a recession. This is going to be our earnings, and our earnings going to be 50% lower if there's a recession. Whoa. Which is right. Actually, it could be much lower than even what he said, because airlines have tight margins and very cyclical. But there's one person. Listen. What I think, every CEO right now of every public company on his or her earnings call, I mean, they should sit down with management and say, okay, given the current tariffs, let's make our best guess of what earnings are going to be later on. Most of them are, I don't know what it's going to be, so I'm not doing the homework to tell you. Basically, that's what a lot of them say. We have all this uncertainty. Well, yes, there's always a world of uncertainty. Well, tell us how you think your business is going to be affected by it. I don't see a lot of that. Of course, it's very early in the reporting season. But the truth of the matter is, it's the responsibility of the CEOs and management to get together. Now, by the way, I think they should give several scenarios. What it is right now, with China, what it is right now. And they probably should give the base. What worries me is that, Trump almost talks like the 10% across the board is going to be the lower bound. And other people say no, but that's the lower bound. And then, of course, if you're 10% across the bound, it's sort of like 20% would be the best you could hope from China. Okay, give us a 10, 20%. How does that affect your it requires some brain power and some work. But that's the only way you do it. I mean, the CEOs have to do that. I think they really want to inform their shareholders of what's going to happen in the future. Of course, those that compile the estimates of S&P earnings, I'll be listening to them. I mean, all those earnings estimates that you see up there, virtually all of them are pre-tariff. Pre April 2nd, and what we see, almost nothing is accounted for, and they're not going to change it. That's not what they do. They don't know. They'll know when the CEOs know, and then CEOs if the CEOs can make a guess on it, then they can change it downward. That's what I would say is their responsibility. So, the only clues we have is the surveys are really terrible. I mean, almost all surveys are dismal going forward. All right. Let me say one other thing. I think when I look at the market, if he says we got a deal here, that'll give a push to the market. Certainly it will, and it encourages the market if we start getting deals. But I would say that if it doesn't go below the base 10 and the base 20 for China, as I've been saying, it's going to be very hard to get to the all-time highs that we experienced in February. I think that this is I would kind of say, without a real reversal on this, and the damage it's done in terms of how you get around the supply chain and all the rest. It's going to be hard to I would say I see a ceiling kind of until that is removed of maybe 10% below that high that we got, and obviously there's an awful lot of emotion there. I think that the excitement. I mean, as I say, my feeling is the amount of manufacturing jobs that all this will bring back is going to be minimal compared to the amount we lost. It is still not competitive for us to produce. Most of what is produced abroad is not competitive to produce in the United States. and will do so only at higher costs and lower real incomes for those people in the United States. Let me just finish as I've been talking to our crew here, and I'm going to let Kevin and Sam talk about it. It was a good day for wisdom tree type stocks, and I think it will be a good day. I think certainly UNH was a shock, but I think I see a narrative change on AI as being vulnerable in all these situations, and it's more than just it started before the tariffs, if we do get reductions in interest rates. By the way, let me say the following. And this can be a very difficult situation for Powell, because if the economy does show some weakness after this pre-tariff buying occurs, and Powell does not lower rates, then Trump has a scapegoat automatically in Jay Powell. He said, okay, why are we having a recession now? Because Powell's not lowering rates. Look, at the ECB is lowering rates. Everyone else is lowering rates. Oil is down. This is down. That is down. Why aren't you lowering rates? And then he has the scapegoat. He says he's going to stick with him for a year. Technically, I don't think he can remove him without impeachment. I don't think that's going to happen. But he can transfer the blame for his own disruption of the economy to Jay Powell. That's the reason why, otherwise we'd have a boom right now. I'm negotiating all this. Got to watch out for that. I mean, not watch out for that. That's a political prediction there in terms of transferring blame on tariffs being cause of a recession, if indeed we do have one, to the Fed and Jay Powell. I'm more and more thinking that that's something that could very well occur. With that, who wants to go next? Kevin?
Sure. Certainly things are a little bit calmer in the bond market today. We've gotten a number of questions about thoughts on the bond market, what's happened. Could there have been dumping from China and Japan last week? Interesting, we get every month the TIX data, it's known, from the Treasury. But unfortunately, it's with a 1 month lag. But I thought it was interesting that both Japan and China, for the second month in a row, actually added to their Treasury holdings so far this year. But there's been no evidence that we have been able to really see a smoking gun of any kind of selling or liquidation from China or Japan. Now, could there have been foreign selling? Absolutely. Bringing it home a little bit, say maybe in the European Union, perhaps bringing money into the Bund market. Bunds have outperformed treasuries of late. That's not surprising, but I think it's a short run phenomenon. We've been down the road so many times that, people are going to dump treasuries. It's going to be a whole changing order. We've been there. We've done that. We were joking on an office hours yesterday. I remember Gisele Bundchen saying that she wanted to get paid in euros however many years ago and not in US dollars, kind of tongue in cheek. So I think what we saw in the bond market was some dislocations for sure. I don't want to dismiss that. You had a reversal of that initial flight to quality trade post-Liberation Day. You had some further unwinding of trades and deleveraging per se, and people just selling money to raise cash. And when you get this confluence of factors and you don't have the same kind of intermediaries in the system as you've had in the past, you can get this turbulence, this dislocation. And I thought it was interesting that it may have been the Deputy Treasury Secretary, it may have been Besson, I don't know which one. They were talking about perhaps putting a pause on the SLR, the supplemental leverage ratio, which is part of the Basel Accords, where banks have to hold capital in reserve for even holding treasuries. And when we went through COVID, the Fed actually suspended that to help the plumbing work a little bit better. So, In my opinion, Professor, when I hear you speaking about the Fed, I do think it's more of that macro kind of thing. I get asked a lot of times, well, there's problems in the markets or the treasury market, the bond market, the Fed's going to cut rates. They tend to go to the balance sheet first.
No, that's not the reason. Yeah, I agree with you, Kevin.
Right. And the other thing, why not, right? Say May, June comes along. Why not just NQT, at this point in time? Or if they wanted to, like in 2019, they could resume quantitative ease as well. So I think right now, if I was a betting man, what I find interesting, prior to Powell's comments yesterday, I was thinking there's no way that if the employment numbers the next couple of months begin to cool a lot more than expected, that's what gave us the 50 basis point rate cut in September. I think Powell would cave and that he would then cut rates. But when you read commentary today, it made it seem like, oh no, inflation may be the 1A part of the dual mandate and employment 1B. I still think when the chips are down and if the economy begins to falter, the employment numbers begin to falter, I think Powell would definitely relent. What bothers me is I would say Powell used it at one of his press conferences. Waller used it last week. I can't believe, Professor, they're coming back and saying transitory again. It's like, can we retire that T word for a little bit?
Never learn.
Well, I mean, the tariffs is, theoretically a one-time increase in prices. So, if you call it a one-time shock, in the same way that the first few months of COVID was, and then they poured all the money on it. And then, when you increase the money supply by 30%, you're going to have, 30% inflation over the next 3-4 years. That's, I predicted it, after 1 month, 2 months, almost exactly what happened. They're not pouring money on this. We don't see a $3 trillion rescue plan at all to offset the trade thing. We're going to have some Trump tax cuts, to be sure. We got a little bit of revenue maybe from the tariffs, but nothing like what happened during the very end of the Trump administration and the whole Biden administration, the one that really poured the gasoline on the fire. So we just don't see that. But it is a one-time shock. It's going to bump up prices depending on how high they stay. But, if the Fed does not, accommodate that with a abnormal increase in the money supply, like they completely accommodated it in 2020, 21, and 22, then that will be a one-shot increase in inflation and then a stoppage at that. Yes, they could stop quantitative ease and tightening. My position is that quantitative ease and tightening is overthought to be an influence on the real economy. It's the interest rate that's really important. And as we know, there are probably $10 trillion of loans that are pegged basis point to basis point to the Fed's rate. Now, when I mean it isn't like it's 4 1/3. It's like the prime rate is set exactly 300 basis points above the Fed funds, and then you get 2 or 1 or a half over prime. So everyone's different. A LIBOR is all set. A SOFR is all set. So, basically they all go off that rate at different levels, but they're tied to that rate. So that would make a real difference. But could it stop a recession? Probably not, unless it was going to be really mild. Would it help? Absolutely. Keep it from being severe, and if it was going to be mild, actually keep us out of it? Yes. This has been the stance all the time. The Fed can help, but the Fed, cannot, completely offset. So, I agree. Once we see the employment numbers, we see, listen, there's not going to be until no one has now, everyone hears on the news, the cars are going to be, X thousand more, whatever. They're buying, inventories are down. They're keeping the prices pretty much the same. But until someone goes to, Staples or something else and said, I bought this for $10 and now it's 15 or 20 because it came from China. Wow. I mean, that's when you really get the political pressure. I mean, everything is now theoretical. Oh, yeah, this is going to happen, that's going to happen. Maybe they'll cut my taxes enough so that, I'll make enough more to offset whatever this is going to be. And, people don't believe things until they see it. And nobody has seen it. It's been all talk so far. Until they see it and go in there and see the prices are higher. Whoa. Okay. Now, then that's why that's why the actual public opinion polls have showed a very slight deterioration for Trump. I mean, he has gone unfavorable from favorable, but a very mild rate because no one has seen it yet. My feeling is once they see it, that could be far more detrimental and hopefully give them the impetus to make a lot of deals that gets us out of that situation. But I can't guarantee, I wish I could. I can't get into his mind and know what he's going to think about something like that.
Sam, that might be a good entree for you as one of our you're focused a lot on the international deals and sort of geopolitical dynamics. Any commentary from what you're seeing this week?
I mean, what I'm seeing this week is pretty interesting returns on the non-U.S. front. And, when you look at the U.S., there's also been some pretty interesting under the surface returns for dividend payers, et cetera, that, are kind of, call it tariff immune or at least tariff aware to a degree. But when you look at what happened with Japan, right, you had a commentary of, hey, we had a good discussion with Japan from Trump. Now, Japan was like, yeah, not a whole lot happened, but it didn't really matter. Japan was going to run anyway because Trump said it looked pretty good. If you look at the trade-sensitive countries, whether it's India, whether it's Japan, South Korea, Mexico, they've done very, very well this week. And one of the reasons they've done well is the suspicion that you're going to have a bleed of these positive headlines for countries. So while it might not be great for S&P, NASDAQ, Dow Jones, if you can even call that an index, maybe it isn't, but it is going to be good for the countries that are cutting these deals. These countries have real economies. They have real outlooks. They have, they're not just tied to the U.S. They are global in nature. So while a lot of us get caught up in, what's going on with the S&P or the NASDAQ, it's not all about that, right? A lot of countries outside of the U.S., a lot of equity indices outside of the U.S. have done extraordinarily well, even with the somewhat negative headlines on tariffs. And for me, that is a signal of, hey, maybe when it comes to a trade war, these countries with relatively low multiples and very well-run companies, that might be the place to look in this type of scenario instead of just looking at the U.S. So that's the way that I'm approaching it, and I think it's worth taking a peek at some of the allies and trade partners that the U.S. has. That may or may not be a great place to put money, not just for the next 12 to 18 months, but for the next, call it decade or so.
Professor, a lot of people are asking about, the mentality on this, on the general trends in the bull market and whether it seems like you're cautious in saying sort of 10%. that we won't go back to those highs. Like, how do you approach your long-term thinking with that caution today? Like, how do you balance those two?
Well, okay, so if we have these tariffs, I mean, first of all, how many years are going to have tariffs? I mean, Trump is president for 3.5 years. Who knows who the next one's going to be? And he can meet an executive order and take them all off. So, we get under that. And my feeling is not going to happen because if it's unpopular and doesn't do anything for the economy and the markets will be taken off beforehand. So it does nothing negative for my long run. In fact, one could argue, if you think eventually they're going to be taken off, you're buying the market 15% cheaper now than you did in February. You're still buying the market, more expensive than you did 2 years ago, but 15% cheaper than you did in February. So from where, and I say while these are on, I see a kind of a ceiling there. Looking forward from there, I see them being taken off. And by the way, if they do stay on, put you into a recession, I mean, I don't see any way they could stay on. And I think the market would rally because then they know that the next president is going to be taking them off. So, and Trump, no matter how much we talk about third term, is not going to be the next president. Let me assure you, no one's going to have no one can get another amendment through there. No, long run stocks are still I think bonds look worse than ever because the deficit is certainly not being helped by Trump. I mean, if you want to look long run, so you're buying 4.3 now, and with no deficit control, and we'll keep on talking. I love stocks for inflation protection, and I hate bonds for it. And the tips are 2.0, so you're that's it. You're getting there, not enough. I mean, so yeah, no, it absolutely doesn't. Doesn't change my long run bullishness about stocks.
I wanted to ask Professor and Sam on this. When you look at what has been transpiring with this whole tariff, you almost get the sense what this really comes down to eventually is the U.S. and China. How does that, if at all, how does that get resolved? I mean, so say within this 90-day pause, you had Italian Prime Minister Meloni today in trying to facilitate with the EU. So say we agree with the EU, UK, Japan, South Korea, Vietnam, all of that, and it comes back to the US and China. How does that get resolved? Or is that just going to be sticking like that burr, that gets under in your sock or whatever? Is that just going to stay as a uncertain negative influence potentially, even as we move past, say, this 90 days into 2026?
What do you fear, Kevin, about China? To answer that question, what do you fear about China? That its economy will become bigger than the U.S.? I guarantee you it will. It has 4 times the number of people. And today they only have 1/4 of the per capita income, so they're the same size as us. It's very likely that that's going to move up, and they will become bigger than that. So they'll become the world's biggest economy. Now, then, are you feared that they will exceed us in AI, and then could that mean military conquest beyond Taiwan and all of Asia and who knows what? I mean, are we going to fear them the way we feared the Soviet Union and communism taking over the world in 1955 and 60 when I was growing up, and 65 and 70 all the way until probably 80? I mean, is that the fear? What is your fear?
My concern is more on the economic side, that, not necessarily taking it out. I mean, the difference, obviously, Soviet Union, the U.S., is we were not importing from the Soviet Union like we are from China. So what does that do to our economy? I mean, it takes a while to
The only
build
reason we do
factories
that,
to get
I
things up
mean,
and
the only
running.
reason we produced in China is because China was much cheaper. Okay. So if we don't get China, we can go to India, we could go to other countries that are cheaper and do almost as well, but it takes time and there's frictions and costs that are involved. If we completely cut ourselves off from the rest of the world, I would say our per capita income would go down by about 5%. That would be a severe recession, and that would be permanent. But it would grow from there. It would just be if we don't take an advantage of what's called the division of labor, which is something that, economists established 200 years ago, I mean, it's been proven through the centuries, your real income is just going to go down. I would say maybe 5, 6, 7%, but from there we can grow. There's, from that point, but, we're just saying, hey, you made it cheaper for us. Now we have to make it ourselves. It won't be as cheap. So we're not going to be as rich. Doesn't mean we're not going to get richer. We're just going to be below the income level that we had before. By the way, China is not cracking. They're not cracking at all. And I read Xi's proposal, at least as reported in Bloomberg. It was really quite. They laid out so much better than Trump exactly what they're going to have. Trade representative. They would prefer They said I'd be honored for Trump to be there, but I don't think it would be best for him to be in the negotiations. They have to respect China. They have this is how it would go. They laid out a procedure to at least start the negotiations. Trump has not responded, to my knowledge, on that. I mean, Trump, to me, said they're going to negotiate. He hasn't set the parameters on some of these negotiations. I don't know what they're going to be. All I do know is that, again, if I'm going to restate what I said before, if every country lowered everything. So if every country lowered if we went to a total free trade country world, yes, we would be better off. 1 or 2% probably better off if everyone eliminated all their tariffs. If we cut off China and we cut off India and we cut off everyone from trade, then we would be 5, 6, 7% worse off. I'm just giving top of the heads, given types of models that have been done. We could grow from there, but that's it. So I say, well, what do you fear about China? Well, what's your real concern about China? China will become the biggest economy in the world in 20 years. And in my opinion, there's absolutely nothing we can do about that. And then there's a question of why should we do anything about that?
There's been a few questions coming up about this related to how to think about the U.S. versus foreign markets in portfolios. We've always talked about global diversification and the attractives of that. Often we get critiqued, even just trying to be closer to neutral to the MSCI world. People still like to be overweight the U.S., partly because the U.S. has outperformed everything for the last 15 years. But
until the last 6 weeks, right? Yeah, I mean, when we talked about this on our last one, but it's worth repeating. We are by far the most expensive market in the world, and we do have. Listen, there is U.S. exceptionalism. This isn't, over. As I say, Trump has 3.5 more years, and who knows what the tariffs are going to be. And, he's not shutting down new entrepreneurs. Anyone can do an IPO, a new idea, and all the rest. So, I mean, it's a question of free, that you can free to pursue any sort of new idea and finance it in the U.S. And I mean, it attracts the mavericks. It attracts those people that like to think out of the box. We are the best country in the world thinking outside the box. We actually lionize people who think outside the box, in contrast to much in Asia, where they're not as encouraged to think outside the box. It's all competition to meet America or whatever, but you don't ever disturb the social order by thinking out of the box. You don't start a company that, could kill employment in a million people or 500,000 people because it's a new idea. And the U.S. is one of the few countries in the world you can really do that because we are founded on those principles. I mean, these are the ingredients that have made America great over time. And, they're still there. Now, with all that being said, does that deserve a 22 PE versus a 15 PE on Europe? Well, we pointed out that in the long run, the differential in PEs become more important than the differential of earnings growth. Earnings growth is really important in the short run. PEs are really important. Valuations become the most important in the long run. It depends on what kind of portfolio you are setting up. That's what's important. So, I still see PEs much lower around the world, and going for the long run, I'm not going to give them up. Certainly, given the events of the last 6 weeks. By the way, I do not call it Liberation Day. What was that? April 2nd. I call that Liquidation Day. I don't think it liberated us from anything whatsoever. I think that day will, in history, be a dark day in the economic history of the U.S. Not that it won't be recoverable from. We've had a number of other dark days, but I certainly think it is a misnamed day, as I thought from the very day that he presented it.
Tim, do you want to touch quickly on your allocation U.S. versus foreign and some of the models that you look over?
That's where I would suggest there's some very interesting opportunities to take advantage of. Not only are they cheaper, but some of them have much better growth opportunities as we move forward. They are not as exposed to tariffs. If you want to dig in and really spend the time on the individual equities and indices, there are some places that really are tariff immune, or at least very, very much not exposed to the tariffs, even on a headline figure. So if you're willing to put in the time, put in the effort, there's a lot of opportunities outside of the U.S. Dollar is strong, and it doesn't matter that you've had a few down days on the dollar. Dollar remains strong, particularly on a real broad basis. It's one of those areas where if you want to pay attention to the next decade, it might not be U.S. equities. It might be outside of the U.S.
Kevin, maybe another word for you. Paul wrote in about Treasury, MBS super sectors and high yield and sort of momentum in some of those for the last few months, and asked a question about the Treasury market as a recession indicator. I'm not sure exactly where he's going with that question. Maybe we could follow up with him. But any other comments, Kevin, as we wrap up the hour that you would get to?
Yeah, real quickly, there was a question about munis, which we don't really talk all that much about. And I find it interesting because we are eventually going to turn the page and get to the extension of the Trump 1.0 tax cuts. And there's been some concerns that perhaps once again, the tax exemption status could be altered or perhaps eliminated. And we really don't see that as happening. I think for the most part that the muni federal tax exemption will stay in place. The one thing that I would note, could there be some exceptions carved out? Maybe some private activity bonds or something like that. That's not without the realm of possibility. So what we're looking at, talking about relative value opportunities, munis have cheapened up a lot here over the last month or so. And that would be an area, I think, of fixed income for investors perhaps to take a look at.
Very good. And Professor, any closing thoughts for you on, we'll do it again.
We want your feedback. You're enjoying them, and, I'm happy to continue to discuss the markets.
We always appreciate getting your insights. Sam, Kevin, Professor, always great to talk to you. Thanks again for doing this.